Imagine you walk into a massive, high-tech vault. You see rows of gold, stacks of cash, and digital screens flashing trillions of dollars. But then you notice a side door, slightly ajar. Inside that room isn't the money people are using. It's the money they've forgotten. It's the uncashed $50 birthday check from your grandmother. It's the $12.40 left in a college checking account you closed years ago. It's the dust left over from millions of crypto transactions. To you, it's pocket change. To the bank, it is the ghost balance, and it is the most profitable asset they own. Most people live under the illusion that banks are like digital shoeboxes. You put $1,000 in, and the bank keeps it safe until you need it. But that's not how the system works. The moment that money touches your account, it ceases to be yours in the way you think. It becomes a liability on the bank's balance sheet. However, there is a specific type of money the banks love even more than your active deposits. Dead money. Dead money is any capital that stays still. In the world of high finance, stillness is a sin for the consumer but a miracle for the institution. When money sits dormant for years, a process called escheatment eventually kicks in, where the state claims it. But in the years, sometimes decades, before that happens, the bank is playing a game you aren't invited to. Under fractional reserve systems, banks only need to hold a tiny fraction of their deposits. When money is dead or forgotten, it provides a permanent, stable base of collateral. Think about this. If a bank has $1 billion in forgotten stagnant funds, they can use that ghost balance to justify lending out $10 billion or more in new loans. They are charging 7%, 10%, or 20% interest on money that was created out of thin air, using your forgotten $12 as the legal anchor. You aren't just losing that money to inflation. Your forgetfulness is literally funding the debt cycle of someone else. But it gets deeper. Have you ever wondered why gift cards have expiration dates or hidden fees? Or why a bank makes it so difficult to claim funds from a deceased relative? It's because the breakage, the industry term for lost or unused value, is pure profit. In the retail world alone, billions of dollars in gift cards go unredeemed every year. That money doesn't just vanish. It stays on companies' books, allowing them to report higher assets, borrow more money, and expand their empire, all because you forgot a plastic card in a drawer. There is a hidden system behind the money you see every day. Most people think the hidden part of finance is some complex stock market strategy or a secret offshore account in the Caymans. While those exist, the real secret is much simpler and much more pervasive. It's the limbo transaction. Have you ever sent a wire transfer that took 3 days to clear? Where was that money during those 72 hours? It wasn't in your account, and it wasn't in the recipient's account. It was in the float. During those 3 days, the bank is moving that money through overnight lending markets, earning interest on it every single second. When you multiply that by millions of people and millions of transactions, you realize that the banking system is essentially a giant machine designed to capture the micro-interest of your waiting time. They are getting rich off the gaps in the system, the moments where your money belongs to no one but them. The misconception is that you are the customer of the bank. In reality, your dead money and your float time are the products they sell to the central banks and the government. They want you to be disorganized. They want you to have 5 different apps with small balances. They want you to lose track of that old 401k from a job you had 3 years ago. Every time you lose track of a dollar, it becomes a permanent tool for their leverage.